What's up? Finesse University at you with another one. So when most people think of making money in the stock market, they're thinking buying a stock when it's low and then selling it when it's high. But there is an alternative way to make money in the stock market by not buying low and selling high. That's the opposite way, selling high and buying low. And that's called short selling. It's a very powerful tool. If you can make money on the way up, and you know, like you can predict when a stock's going to go up, or you can forecast and have your strategy down to a point where you have a good idea when a stock's going up, when it's in an uptrend, then you can also have an idea for when it's going to go down. Like a lot of times when a stock goes up 150% or 100% really fast in a couple days, or whatever the different time frames you're in, it goes up, the volume increases and it goes up really fast. A lot of times it has to pull back, it has to correct itself. And that's where you can make money short selling and developing a short selling strategy. So a lot of people don't understand what short selling actually is and how it works. And I really didn't until recently, probably I've been trading for like 4 or 5 years, and I didn't really understand how short selling worked until like last year. So I'm going to try to, it's not really important. Like, you don't need to know how short selling works in order to make money, but it's helpful knowledge, and it's useful knowledge. So how short selling works is, let's say we have a pair of Jordans, or you're going to short sell a pair of Jordans. I'm your broker. I'm E-Trade, I'm Robinhood, Fidelity, whatever. I have 10 pairs of Jordans. We'll say the Jordan 12. So I have 10 pairs. And you, the client, you want to short sell a pair of Jordan 12s. So what you're going to do is you're going to come to me, because I'm E-Trade or Robinhood, and you're going to say, hey, E-Trade, I want to short sell a pair of Jordans. So I'm going to take my pair of 12s and I'm going to sell them on the open market. So I'm going to sell them to someone on the market, we'll say for $300. So I take that $300 profit, because I just sold the pair of Jordans that I had. I take that 300, not profit, but I take that 300 and I give it to you. And I say, go crazy, go buy me another pair of Jordan 12s to replace the pair that I just borrowed or lend it to you. So what you're going to do is, with your $300, you're going to wait for the price to go down. So hopefully the pair of 12s get the price for the 12s go down to $250 or $200, and you're going to go out and you're going to go and buy another pair of 12s to give me. So let's say the price goes down to $200 for a pair of 12s on the market. Now you're going to go and buy a pair of 12s. You're going to give me the 12s, and that extra $100 that's there is now yours to keep. Now on the flip side, if the price were to go up, so let's say I sold the Jordans for $300, you have the $300 cash, but now it costs $400 to get a pair of 12s. Now you're going to have to go and use $100 of your own money to go and buy a pair of Jordans to give back to me, because I need my Jordans back. Like, you borrowed the Jordans from me, I need the J's back. And that's how short selling works. So with stocks, I'm your broker. I have, say, 10 shares of Tesla. You want to short a share of Tesla. So I'm going to go sell one of my shares of Tesla on the open market for whatever the price is. You're going to get that cash, and you're going to hope for the price of Tesla to go down so you can buy a share of Tesla for a lower price, and you get to keep that extra. Now, this can be a very dangerous strategy, because you can lose unlimited amount of money. Like, when you're going long or you're buying a stock, the worst that can happen is you can lose your investment. So you spend $1,000 and you buy some Google, some alphabet company, and like the price is at 500 when you buy it, and now it's at 0, so you lost your investment. Now with short selling, say you buy that Google for 500 and it goes up to 1,500. Now you don't have the, like, you only got $500 cash to work with after your broker E-Trade sold the Google for his Google for 500. So now you have to get more funds in order to pay for that $1,500 that Google now is. So it can be extra risky, and they do deploy ways to prevent that risk from getting out of control. Like if you're short selling a bunch of shit, there's things called margin calls. So like you have to have enough cash in your account to pay them back, because with the E-Trades, what's most important for E-Trade and Robinhood and all these brokers is they get their money back, that they get their interest. So it's something that you can incorporate into your strategy. It's very powerful. You need to have a margin account in order to short sell, which means they lend you money. We'll get a video about margin accounts later, but it's very powerful. You can make money. If you can make money on the way up, you can make money on the way down. So, look into it, do some more research. But that's pretty much how it works, and you can make some good money short selling stocks. I've made some money doing that. So, yeah, good tool to have. If you have any ideas for any videos, let me know in the comments. Leave a thumbs up, subscribe to the page if you got any value, and we'll get back to you next time.